why is a document review or even a life insurance review so important. So I was referred into a case, and I will never make mention of a client's name, and not even enough detail to where somebody who would maybe know the client be able to put it together. But I was in another state. I worked with a large property and casualty agency. They would refer me their clients. I had lovely clients. And also really nice insurance agents, really competent. So there's one gal who I did quite a bit of work with, her clients, and she referred me into a client who did not really want to meet with me because his CPA had come up with this very good strategy for transition. It was a community property state, and he owned a large business that serviced, let's just say, the hospitality industry in that area. And so it took her maybe a month, a number of visits to have him allow me to come in and meet. So I was fine with that. I was plenty busy. But was interested in what this person had put together. And so eventually she was able to persuade him somehow to let me meet with him for 5 minutes. And so it was interesting because I sat down with him and he said, Kirk, I don't need your services. I've got a great plan. He told me about the plan. He said, my CPA is the trustee. He's the one who came up with it. And I personally know that CPA, in my business, and he is a very good CPA. And so I was there, and I said, well, I would still like to review your documents. You have them for me, so let's review them. Well, it was a really neat plan because as far as in concept, because the client was going to, it's a community property state, and both the husband and wife owned 50% interest in this large company. Husband was going to leave his portion of shares to the wife, and in a community property state, the wife would get a stepped up basis on the value of his shares and hers at the day of his death when he transfers those. So what that means is now if she goes to sell his, hers, or all the company to someone else, including an heir, there's no long-term capital gain that is washed. That's what a stepped-up basis does. As long as the sale, from the time that my client died to the time the sale was consummated, that there was no additional increase in value. So generally, most of the long-term capital gain exposure is washed. So he was going to leave that asset to his wife. His wife was going to sell that asset to a trustee who had this life insurance policy inside of this trust, and the trust was going to have the cash to purchase the asset from mom. Now she would have the cash, no tax consequences for her, no income tax consequences. She could now invest the money, do whatever she wanted to. Now she was autonomous from the business. If it was successful or failed, it was no risk to her. And then the trustee was going to then take the stock that he had purchased and distribute it to the kids, which was a good plan. And so mom loved that idea because now she was going to be free from worrying about the business. It also planted liquidity in their estate, so if there were taxes due, which there would have been, they would have the liquidity in the estate to pay those expenses because estates pay their own taxes. Beneficiaries and heirs do not pay the taxes unless you're talking about an IRA. But we can talk about that later. But so she would have liquidity, and then anything that was left that she did not spend, she could leave equally to all the kids. So it's that ability to solve all of these problems, and this was the CPA's design. There was a buy-sell agreement. There was an obligation for the trust to purchase the assets from mom, and mom's obligation to sell the assets. There was a valuation method. How are we going to do it? There was terms. It was going to be beautiful. I went in to review the documents. It was really interesting. Found that the trust, which was supposed to own the life insurance, had a bank account, which was good, but it only had about $50 in the account. So it was an unfunded trust. So the ability to purchase those assets was not going to happen. The buy-sell agreement was drafted, and it was a decent buy-sell agreement, but it was not executed. It did not have the force of law behind it. So there was no obligation to sell. There was no obligation to buy. So that wasn't going to happen. And then the life insurance policy, which was supposed to be owned by the trust, was owned by the company, which it's not settled whether that would add value to the company and possibly balloon the value of the company for estate tax purposes at his death. So that was a small concern, but it was owned by the company, so that was in proper ownership. And then it was a second to die contract, which means it wasn't going to pay at the first death anyway. It was going to be absolutely useless. And so, not having any desire to impugn what the CPA had done, and I have no desire to replace advisors. So but I did bring in my attorney, very competent, and we redrafted the buy-sell, redrafted the trust, redid the insurance, had everything executed, and the CPA agreed to it, and we have, again, no interest in making anyone feel bad about what they've done or haven't done. That has nothing to do with what we're trying to do, just to take care of the client. And so we had it all redone, everything executed, and now that plan is in play. And it will work swimmingly. Washing tax, creating family continuity because all the assets will now be distributed. The residual cash will be distributed equally to the kids, and we'll accomplish our objective. So that's the reason we do reviews, because what people remember about their estate documents, what people remember about their corporate documents, what they even remember about their life insurance becomes muddied, nebulous after years, because it's not on our minds every day. If you're in business, you're not thinking about those every day. So that's a reason to do those reviews.